Hello and welcome to our YouTube channel. In this video, we will be discussing one of the most fundamental concepts in finance, interest rates. Whether you're a seasoned investor or just starting to manage your money, understanding interest rates is crucial to making informed financial decisions. So, let's dive in. But before we continue, make sure to subscribe to the channel and hit the bell icon. What is an interest rate? The interest rate is the amount a lender charges a borrower and is a percentage of the principal, the amount loaned. The interest rate on a loan is typically noted on an annual basis known as the annual percentage rate, APR. An interest rate can also apply to the amount earned at a bank or credit union from a savings account or certificate of deposit, CD. Annual percentage yield, APY, refers to the interest earned on these deposit accounts. Understanding interest rates. Interest is essentially a charge to the borrower for the use of an asset. Assets borrowed can include cash, consumer goods, vehicles, and property. Because of this, an interest rate can be thought of as the cost of money. Higher interest rates make borrowing the same amount of money more expensive. Interest rates thus apply to most lending or borrowing transactions. Individuals borrow money to purchase homes, fund projects, launch or fund businesses, or pay for college tuition. Businesses take out loans to fund capital projects and expand their operations by purchasing fixed and long-term assets such as land, buildings, and machinery. Borrowed money is repaid either in a lump sum by a predetermined date or in periodic installments. For loans, the interest rate is applied to the principal, which is the amount of the loan. The interest rate is the cost of debt for the borrower and the rate of return for the lender. The money to be repaid is usually more than the borrowed amount since lenders require compensation for the loss of use of the money during the loan period. The lender could have invested the funds during that period instead of providing a loan, which would have generated income from the asset. The difference between the total repayment sum and the original loan is the interest charged. When the borrower is considered to be low risk by the lender, the borrower will usually be charged a lower interest rate. If the borrower is considered high risk, the interest rate that they are charged will be higher, which results in a higher cost loan. Simple interest rate. If you take out a $300,000 loan from the bank and the loan agreement stipulates that the interest rate on the loan is 4% simple interest, this means that you will have to pay the bank the original loan amount of $300,000 plus 4% x $300,000 equals $300,000 plus $12,000 equals $312,000. Compound interest rate. Some lenders prefer the compound interest method, which means that the borrower pays even more in interest. Compound interest, also called interest on interest, is applied both to the principal and also to the accumulated interest made during previous periods. The bank assumes that at the end of the first year the borrower owes the principal plus interest for that year. The bank also assumes that at the end of the second year, the borrower owes the principal plus the interest for the first year plus the interest on interest for the first year. The interest owed when compounding is higher than the interest owed using the simple interest method. The interest is charged monthly on the principal including accrued interest from the previous months. For shorter time frames, the calculation of interest will be similar for both methods. As the lending time increases, however, the disparity between the two types of interest calculations grows. Compound interest and savings accounts. When you save money using a savings account, compound interest is favorable. The interest earned on these accounts is compounded and is compensation to the account holder for allowing the bank to use the deposited funds. If, for example, you deposit $500,000 into a high-yield savings account, the bank can take $300,000 of these funds to use as a mortgage loan. To compensate you, the bank pays 1% interest into the account annually. So, while the bank is taking 4% from the borrower, it is giving 1% to the account holder, netting at 3% in interest. In effect, savers lend the bank money which, in turn, provides funds to borrowers in return for interest. Borrower's cost of debt. While interest rates represent interest income to the lender, they constitute a cost of debt to the borrower. Companies weigh the cost of borrowing against the cost of equity, such as dividend payments, to determine which source of funding will be the least expensive. Since most companies fund their capital by either taking on debt and/or issuing equity, the cost of the capital is evaluated to achieve an optimal capital structure. How are interest rates determined? The interest rate charged by banks is determined by a number of factors, such as the state of the economy. A country's central bank, example, the Federal Reserve in the US, sets the interest rate, which each bank uses to determine the APR range they offer. When the central bank sets interest rates at a high level, the cost of debt rises. When the cost of debt is high, it discourages people from borrowing and slows consumer demand. Also, interest rates tend to rise with inflation. To combat inflation, banks may set higher reserve requirements, tight money supply ensues, or there is greater demand for credit. In a high-interest rate economy, people resort to saving their money since they receive more from the savings rate. The stock market suffers since investors would rather take advantage of the higher rate from savings than invest in the stock market with lower returns. Businesses also have limited access to capital funding through debt, which leads to economic contraction. APR versus APY. Interest rates on consumer loans are typically quoted as the annual percentage rate, APR. This is the rate of return that lenders demand for the ability to borrow their money. For example, the interest rate on credit cards is quoted as an APR. In our example above, 4% is the APR for the mortgage or borrower. The APR does not consider compounded interest for the year. The annual percentage yield, APY, is the interest rate that is earned at a bank or credit union from a savings account or CD. This interest rate takes compounding into account. How does the Fed use interest rates in the economy? The Federal Reserve, along with other central banks around the world, uses interest rates as a monetary policy tool. By increasing the cost of borrowing among commercial banks, the central bank can influence many other interest rates such as those on personal loans, business loans, and mortgages. This makes borrowing more expensive in general, lowering the demand for money and cooling off a hot economy. Lowering interest rates, on the other hand, makes money easier to borrow, stimulating spending and investment. Interest rates are a crucial concept in finance that can impact our daily lives in many ways. Whether you're taking out a loan, buying a house, or managing your savings, understanding how interest rates work can help you make informed financial decisions. Thank you for watching, and we hope you found this video helpful. Don't forget to like and subscribe for more informative content.